All right, why don't we get started? So thank you very much for joining. I'm Mark LaMonica. Today we're going to talk about long-term investing, which I think is a good topic. But first, anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. But of course, ask questions. If you are in New Zealand and you want a copy of our FAP, you can go to our website, morningstar.com.au. And also the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you do want personal advice. So a couple of things: you can, of course, listen to our podcast, follow us on Instagram. Anyone who's going to the ASIC Investor Day on Saturday, we will be there, including Emily, who's hiding off camera. Earlier, I said that I was going to put her on camera today because Will's out so I can control it, but she said she would kill me if I did that, which is not very nice. But anyway, we're going to talk about how to invest for the long term. So, a couple things. Number one, we've got this quote from Seth Klarman, who is a pretty famous hedge fund manager. And he's saying the single greatest edge an investor can have is long-term orientation. So let's talk a little bit about why long-term investing is popular. So first of all, we'll get back to this quote that Seth had talking about edge. And we do talk about this a couple different times on here, but we talk about what is the source of advantage you have as an investor, particularly an individual investor when you're dealing with lots of professionals, lots of other individual investors. And one of the sources of edge, or one of the advantages that we have, is of course the ability to invest on over the long term. And a lot of investors don't do this. A lot of investors don't do this because it's difficult to do, which we'll get into today. But a lot of investors also don't do this, particularly professional investors, because of all these structural impediments to doing it. And it's just this notion that if you are running a fund, you need to keep up with the benchmark, you need to keep up with your peers, or there will be big outflows of money, which are very bad things for you. And so what does that mean? It means that a lot of investors are going to do similar things, and they're going to churn their portfolio a lot and turn it over a lot. So even though many professionals will come out, basically all will come out and say they are long-term investors, the data does not actually say that that's true. If we look at the portfolio turnover in a lot of professionally managed accounts, we can see that it's very high. And just, something to think about. If you are ever looking at portfolio turnover, here's somebody talking about how they're a long-term investor. Basically what it will be is it'll be a percentage. Let's say it's 50%. Well, that means every year they're turning over half of their portfolio, that 50% of those positions are new, which means basically in 2 years, you've got an entire new portfolio. So just remember that a lot of people talk about long-term investing because they feel like they need to do it, but not a lot do. So why should we strive to invest for the long term? Well, number one, of course, is that if we're taking a long-term approach, and this is more of a mentality thing, and we are certainly patient, it makes us less likely to react to short-term noise in the market. And that's just the fact that there will naturally be ups and downs, that naturally there's a bear market every 3 years. Naturally, we're going to get a bunch of people piling into very speculative investments at the top of the market. But if you're focused on long term, you can ignore all of that. And we'll talk a little bit more about why that's bad. But good thing to focus on the long term. The other thing is we think about investing, and we think about investing over the long term. We're going to start thinking about real returns, or returns we get in excess of inflation, because that's what really matters. That's why we save and invest, or that's why we invest, that we are trying to protect our purchasing power, and we're trying to add a return on top of that. So when you focus on the very long term, you can take that perspective around how you want real returns and what you're actually trying to achieve, rather than these short-term looks at market movement and trying to get the best return, not thinking about inflation, not thinking about those real returns. Minimize taxes and transaction costs. So those are huge. So the more you trade, the more you are most likely going to pay in taxes, and definitely in transaction costs. And remember, transaction costs are not only just the overt ones, where of course you're paying a commission to trade, but also just the bid-ask spread that you're dealing with. So that is a underappreciated cost of transacting often. And we're going to spend some time at the end talking about this A long time period is where a fundamental valuation driven investing approach works. And there's a lot of history or a lot of evidence, and certainly we're proponents of it here at Morningstar, that that is the best way to invest over the long term. But we'll get into what that means. But let's talk about mistakes. So we talked about all the positive things about long-term investing previously, but also it will help us minimize the mistakes we all make as investors. And first off, we are all going to make mistakes. So it's something that we need to come to terms with. But success over the long term is about minimizing these mistakes. And there are hundreds and hundreds of studies. I picked out two, that show that basically trading and turning your portfolio does not lead to outcomes you want. So the first thing that shows how trading generally leads to bad outcomes is this study from UC Berkeley. It's basically looking at investors and looking at what they sold in order to fund new purchases in their account. It's the definition of trading, right? They're getting rid of one position, they're buying another position. So very different than just saving and investing over time. So they did this study and they just very simply looked at what was sold and what was purchased, and then tracked how those did. So we make pretty poor decisions as investors, as you can see, over 84, 252, and 504 trading days after that sell and buy, you can see that the shares that were purchased underperformed in every single case. And if these don't look like huge numbers, they are huge numbers over time. So it's a good mentality to have. The chances are when you are making one of these decisions to sell something and buy something else, whether you're disappointed that something that you purchased and put in your portfolio didn't do very well, or whether you're tempted to buy something else, buy anything you've heard from a mate, from the newspaper, anything, or you're just chasing returns, just realize that chances are you are going to have less wealth because of that decision. So just having that mentality can make you make you more thoughtful, which hopefully will make it less likely that you're going to go out there and do this all the time. And you're going to put more scrutiny over those decisions you're making. The other thing is another study by two professors looked at 78,000 households between 1991 and 1996 and basically divided up into quintiles investors based on how much they traded. So what we can see is the least active traders and the most active traders. So first we look at monthly turnover. So I was talking about annual turnover. Turning over 21% of your portfolio in a month is a lot. That means you basically have an entire new portfolio in 5 months. So these are certainly people that are trading a lot, and you can see that their average annual portfolio return is a lot lower. Now, these are high numbers, by the way. So we should realize that. And that's just kind of the time period that occurred. But either way, you were giving up a lot of returns by trading often. Partially because of this top study that people are generally making poor decisions when they're exchanging something for something else, and also just because you of course have to pay all those taxes, transaction fees, etc. So some good reasons not to trade too much. All right, so let's go through some tips and we'll get into a little bit around fundamental investing. So how can you make sure that you invest for the long term? Well, one, and people hear me talking about this all the time, is you need to understand what you want to achieve. So having that basis of where you want to get is very, very important. And then, of course, designing a strategy that is aligned with those goals, those long-term goals, is also really important. And just defining a strategy in itself is important. And write it down. We did a couple of weeks ago, we did one of these where we actually filled out that investment policy statement. We're not going to do that again, but write it down. Make sure that you are aware of what your strategy is so that every time you get tempted by somebody telling you you need to invest in whatever it is, then you can go back and say, does this align with my strategy? That doesn't make that suggestion a good one or a bad one, but if it doesn't align with your strategy, then something you shouldn't do. This can also focus you on the long term and make sure you're not trading too much. And nobody, almost nobody, tries to trade too much. It's another important thing. There are certainly people that are day traders, but we're kind of excluding them. Nobody is trying to turn their portfolio that much, but it just kind of happens. It just kind of happens because we get to hear all these ideas, and the ideas obviously are sold to us in a very compelling manner. And then greed takes over, and we think we have to get into this investment if we want to, quote unquote, make lots of money. Maybe you don't need to make lots of money. Maybe you just need to hit your goals. Have a strategy that prevents you from just bouncing around from idea to idea, getting influenced by everyone you talk to or everything you read. That will help you focus on the long term. The second point, one that I also talk about all the time, is finding investments that resonate with you and that you understand. So we'll start sort of with that last thing, understand, which is, of course, the circle of competence that Warren Buffett talks about. Now, the circle of competence came about, and he started talking about that around the dot-com bubble. And Buffett was heavily criticized because he was not investing in all these internet stocks. And he basically just said, hey, I don't understand them. I don't understand how I'm supposed to value something that's based on clicks or eyeballs or whatever made up metrics were being used back during the dot-com bubble. So he said, I'm not going to invest in them. And he was criticized significantly. He underperformed the market for a couple of years. People said that he was too old. And this is back in 2000. I mean, now he's in his 90s. So he was too old then. I don't know what he is now. But people said that he was too old. He didn't understand the future. Well, in that case, he obviously had the last laugh. But it is important to invest in things you understand. The reason it's important to invest in things you understand, businesses you understand, business models you understand, is because, of course, when bad things happen, and they will to every single company, when bad things happen, you can then sit there and say, okay, well, I actually understand the impact it's having on the company, and I don't think it's that big of a deal. I think the company will bounce back. And every company goes through these cycles. So company that's in the news a lot is Meta, or Facebook's parent. And they're, of course, going through a really terrible time right now. So obviously there's a lot of headwinds around the social media side of things, whether younger people are gravitating towards TikTok, the privacy stuff with iPhones and how that impacts advertising, just the fact that as the economy slows, less people advertise. And then, of course, you've got this whole metaverse thing that they're investing billions and billions and billions of dollars into. It doesn't seem to be going that well, and a lot of people can't understand how that actually is going to be the future of, I don't know, everything. Now, I don't have an opinion on Meta one way or the other. I don't own it. I probably wouldn't. But if you are going to own a share like that, you better understand the metaverse, and you better understand deeply what the potential is, not just following headlines and things like that. So the idea is you understand these companies, and if you truly believed in the metaverse and you truly believed that Facebook was the company that is going to make that profitable, then maybe you'd sit there in this environment where the share price has fallen so much, and you would say, okay, this is a great opportunity. Well, it's just the notion of understanding what you're investing in. Excuse me, the pollen is making me cough a lot, which is great for everyone. Sorry about that. The other thing is obviously something that resonates with you. So understand the business and also believe in the business. So say Meta example, believe in. See, you are going to have to do this, Emily. She will kill me. Excuse me. Believe in the type of investment that it is. Now I've lost my voice. This is going very well. Emily looks terrified. Sorry. Anyway, another thing that you can do is contemplate the investment risks that directly impact your plan. So we talk about investment risks all the time, but think about the ones that matter to you. And one of the chief things that we should think about, excuse me, is volatility. Now, volatility, of course, is how much your portfolio is bouncing around. And understand when volatility impacts you and when it doesn't. So it probably doesn't impact you if you have 40 years to go to your goal. Who cares? Does impact you, obviously, as you're approaching your goal. But understanding those risks can put these market movements into context, which means you're less likely to actually react to them. So that's another important one. And then finally, what we'll spend the rest of the time, if I don't cough myself to death, is understanding the investment approaches that will work over the long term and the drivers of that success. So we hear all these different investing strategies and approaches, and some are certainly more geared towards the long term, and some are, of course, short-term strategies. Now, I'd obviously recommend that you focus on the long-term ones, but there are certainly short-term strategies, whether you're looking at technical analysis, whether you're trying to understand where the market's going to move in the short term versus things like momentum versus just momentum and volume and things like that people are looking at. These are all very short-term strategies. Even people playing the economic cycle are very short-term strategies as you rotate into different sectors. Now, over the long term, these things don't really matter. Over the long term, what we want to focus on is some of those fundamental investing techniques, which we'll get into in a second. Okay, so we got a question. So David says, what then is your metric to trade? Do you trade a stock because of poor returns or because it's not appreciating? CSL is an example. I say pretty much the same price for the past 3 years, pays poor dividends, yet every stock person claims that it's a great stock. I think that it was a great stock for early investors, but now it is value for the cost of investment. Okay, so really good example. So CSL, and one of the things that we do need to understand is what does it mean by a great stock, and what do people mean when they say that? So CSL obviously has done very, very well, as David is alluding to, which means there are going to be a lot of cheerleaders out there, right? Kind of the same people, right, that got in CBA right at the beginning. And so you have this sort of cohort of people that obviously are huge cheerleaders because of what something has done in the past. What we care about, of course, is what it does in the future. And yeah, CSL has had a pretty flat couple years. If you look at what our analysts think, they think it's about fairly valued now. So they did think it was very overvalued, and they think it's come back a little bit. But if we want to talk about great stock, well, we need to start thinking about that. And we'll get into this a little bit in the next couple slides with fundamental analysis. We need to start thinking about, okay, what does that mean? It means it's a great business. What is a great business? A great business is a business that can sustain high margins, that can sustain high returns on invested capital over time. Let's talk about what those two things mean. Basically, what we care about as shareholders is we care about what flows to us and what is actually going to negatively impact what flows to us as shareholders, those excess profits. What's going to negatively impact? It's competition. Right. So, and I know I've said this a couple different times on here, but capitalism, the heart of it is competition. And competition is great for us as consumers because obviously we are getting better deals, we're getting better products as companies compete on price, and they compete by investing in the products and services that they sell. But those are all very bad things for us as shareholders because those cost money. Right. So if a company that we own, just like if we fully own that company we own has to lower prices to maintain market share, that's a very bad thing. That means the company's less profitable, and we'll see that in margin. The other thing is, of course, that impacts margin is if the company has to invest a ton in creating new products. Ideally, if we had to design the perfect company, we would want a company that never had to invest in their product. And a really good example of that, if you think that that doesn't exist, pretty good example of that for a long time, it's changed a little bit recently, has been tobacco. As I keep coughing, I'm actually not a smoker despite what's happening right now, is tobacco, right? For a very long time, there weren't a lot of improvements in cigarettes. Yeah, they called them different things and threw some fancy titles up there, but basically the same thing that had been happening for hundreds of years was happening, that you were wrapping tobacco, dumping a bunch of chemicals in there to get people addicted, and selling a cigarette. So that's a perfect example of where you don't have to invest in product innovation. The real world, obviously, companies are always going to invest, but as if they can do it as little as possible, that's a very good thing for us. So we're looking at margin, we're looking at return on invested capital. What are the returns that the company earns when they invest in that business, and are they higher than the cost of that capital they get? Over the long term, that's what we're really interested in terms of a great company. One other caveat I'd add to this is a great company, also the benefits of that accrue over the long term. So those small changes or those small differences in what they can invest in the company and what their cost of capital is, that'll accrue over the long term. So I think about that with CSL. And I'd say that 3 years is not a long time. And yeah, companies at some point get ahead of themselves versus price. But think about if you think that CSL will continue to have competitive advantages over the long term and will continue to earn those excess returns for shareholders. And then, of course, you got to think about the price and what price is a good way to get in there. So hopefully that answered a little bit of your question, David, as I coughed through it. But let's talk about some of these strategies. And I alluded to a couple of them. And we're going to talk about fundamental analysis. And there's our friend Warren Buffett. I don't know when that was taken. He looks younger than he does now, which is a little bit scary. But, geez, sorry. This must be horrible to listen to. There is this quote that's one of the most famous quotes in investing that's under Big Warren's head there. In short run, the market's a voting machine, but in the long run, the market's a weighing machine. So this is where we can start to differentiate between short-term strategies and long-term strategies. So over the short run, what is going to drive share market prices? Well, really what's going to drive them are supply and demand. So at the end of the day, if we want to know if a particular share price is going to go up over the day, the question is there more buyers than sellers, right? It is a marketplace. And so it is going to be demand for that share and supply for that share, people that are willing to sell it. It's going to change those prices over the short term. And this is where we get into all of these predictions about the market. And we hear this stuff all the time. We hear that it's a good year to buy shares this year because it's a US midterm election. All right, well, maybe not. We'll find out. Hasn't been a great year so far. We learned that there are certain months that we're supposed to buy shares and certain months we're not, right? This whole sell in May and go away type of thing, this Santa Claus rally before Christmas, all this stuff we hear, this is all short-term noise. So I would encourage people to ignore all of that. So whether it's true or not, there are stats about presidential years, there are stats about odd years and even years and when you're supposed to invest. There's all sorts of stats out there, but it's all just short-term supply and demand related noise, right? But over the long term, and that's the voting machine portion, over the long term, when Buffett says it's a weighing machine, what actually matters is how the business does, right? So if we are a long-term owner of a business, we're a long-term owner of CSL, we don't care about whether it's going to go up in October and down in November. We don't care about all these little things that are going to affect it in the short term. And I would still say 3 years is probably the short term. We care about two different things. We care fundamentally, is it a great company? And also, did we get in and did we buy that company at a good price? Right. So if you bought CSL 10 years ago and you're looking at how it's performed in the last 3 years, you probably don't care. Maybe that's a little bit of David's question, where he's talking about a lot of these cheerleaders are people that have been very long-term holders. But I think also, if we put ourselves in their shoes, we can say that, yeah, maybe their overall impression of the stock is based on the fact that they got in very early and made these outsized returns. But it also could be that, okay, they're very focused on the long term. They're still long-term investors. And they see what's happened in the last 3 years as being just a blip. And, you know, if you go back and look at any share, as I said before, any company is going to go through problems at a certain time. Any share price is going to be flat or very negative at certain times. It's happened to, you know, if you want to talk about Facebook that we talked about earlier, Facebook right out of its IPO fell pretty significantly. Well, Obviously, it's had a bad year this year, but over the long run, it's done pretty well. So I think we just want to be very focused that, what is going to be the driver of returns over the long term? And if we are long-term investors, that's what we need to focus on. And so really a strategy, as we talked about on the first slide, is sort of this fundamental analysis, understanding that company, understanding the competitive environment with which that company operates is really, really important on a long-term perspective. And it's also very important the price that you get into that company. All right. And why does this matter? Well, there's a couple of reasons it matters. I like this cartoon. I think it's kind of funny, but we want to understand the company. We want to perform that fundamental analysis about the company to truly understand and have perspective about what's happening, how that will impact the company. Emily does not seem to like this cartoon. You don't think this is funny at all? She says kind of. Anyway, these are obviously people looking at different parts of an elephant, can't figure out what it is. But we want to understand a company. We want to understand that competitive environment they operate in so that we have perspective. So that when we hear news about the economy, when we hear news about the company, we can put that in its proper place. So let's talk about specifically why that matters and how we can do this. All right, how we can put that competitive environment in its proper place. So what are some good things to think about if you are going out there and analyzing a company? We can use this on CSO or any other company. So first thing is, let's look at this total addressable market. So the total addressable market is not necessarily for the company, but we're looking at the industry at a whole and think about, okay, what is that overall revenue pie for that industry? Now, we need to be a little careful with this because I think many people sit there and say, oh, if we think that this is really going to grow that much, then this is a great place to invest. Maybe it isn't. But we first just have to get that perspective. So is it growing? Is it shrinking? Or is it staying the same? And companies can operate and do well in all of these different environments, whether that overall revenue is growing, whether it's shrinking, or whether it's staying the same. But we just need to have that perspective before we dive into it. Then we can start thinking about the company. And we think about this competitive dynamic within that overall pie, right? To try to capture that pie. Who are the competitors? What are the main drivers to see if they're able to compete in this? And what we're specifically looking at is, do we think that the company is going to grow market share while maintaining margins? So basically, in any of those perspectives, is this company going to take more of that pie or less of that pie? And how are they going to do it? And be very careful about margins. Because, of course, cutting prices is sort of it's a very popular way to grow market share. But that obviously isn't great for us as investors. And a good example, we want to look at this overall pie, is Amazon. And we think about what Amazon has done. And if we just consider not online retailing, but if we just consider retailing, that's really the space that Amazon operates. So what have they done? Well, what they have done, and they have been in I would say in that case, a total addressable revenue, if we think about it just as retailing, one that hasn't grown that fast. Hasn't been some real fast growing industry. If we think about where they started with books of all things, right? Not exactly a growth industry, but what did they do? They were able to grow market share significantly within that sort of existing addressable market. How did they do it? Well, they basically delivered. They were able to sell stuff for cheaper, and they kept reinvesting those savings in the business. So they were not cutting their margin, but they also were not expanding it, right? They were using their lower prices, using the fact that they could deliver stuff for cheaper. They were using those lower prices to actually increase their market share instead of potentially just having a higher margin, right? So those are the decisions they made. But it's thinking about, what was going on with that overall market? What was going on with that company? So cutting prices, increasing investments to maintain market share, that's pretty bad. right? So at least if you're growing your market share, that's a good thing. But if you have to cut prices just to maintain your market share, that's not great. And of course, you can be losing market share. And then we have to think about how these factors play out in earnings in the future, right? So number one, obviously a very fast growing industry. All you have to do is maintain your market share and you will grow earnings over the time, right? Question is how much flows, or at least grow your revenue over time. Question is how much flows down to profits. Or you, of course, could be in a shrinking industry where your market share keeps growing. So that is kind of the tobacco industry at the end of the day. If you look at a couple of the very successful tobacco companies, even as that overall market reduced, they were still able to grow their market share and grow their profitability. So all we're trying to look for here, right, is we're trying to look for and we're trying to understand what is this environment that companies operate in, and this can provide that perspective if you kind of go through this checklist. All right, we've got a couple of questions. Okay, we had somebody that liked the cartoon more than you, Emily. We got another question. Could you reconcile investment styles, value, core growth with stock characteristics, sensitive to defensive and cyclical? Yeah, absolutely. So if we think about different investment styles, so we'll go through sort of value, core, growth. So basically what we do when we talk about those investment styles is we divide up the universe of stock by valuation levels. Simple as that. We'll get into sort of the investment approach that people take. But when we divide stocks up into value, core, and growth, all we're doing is looking at valuation levels and ranking them, right? So the really cheap ones go in value, the middle ones go in core, and then the most expensive ones go in growth. Now, there's also kind of this notion of being a value investor. And being a value investor is about fundamental analysis, but it is very, very focused on that price, so less focused on how great of a company it is. And I actually had this question, I was talking about something similar at the ASIC Investor Day in Brizzy on Saturday. And I had this question about Buffett's a value investor. Does that even work anymore? And, what I would say is, Buffett, I think, has evolved from being a very much value investor back in the 60s to somebody now who, I'd say is looking for growth at a reasonable price. You started looking at some of the shares that Buffett has purchased. His biggest position is Apple. We really call Apple a value stock. So just don't confuse the investment styles in terms of like how we divide up the universe of shares with sort of this notion of like value investing and growth investing. So the other thing, the stock characteristics that Phil's talking about. So we have companies, basically we have non-cyclical or defensive. We have cyclical. So non-cyclical is not going to move around a lot. The sort of revenue opportunities are not going to move around a lot based on the economic cycle. Cyclical is going to move around a lot based on the economic cycle. And then sensitive is kind of in the middle. So there's some impact of where we are. So how do those two things line up? Well, generally, a lot of the sort of the traditional value sectors fall into more cyclical shares. So like places people look for value, whether that is financial services, whether it's things like energy, tend to fall into those more cyclical, shares. And part of the reason is just the fact that people aren't going to be willing to pay as much for a company whose performance is going to deviate based on where we are in the economic cycle. I think in an ideal sense, if you could purchase this at a good price, you really want those kind of defensive companies that will perform well in any investment environment, any economic environment. You just don't want to pay too much for them. And a lot of them are things like tech shares at the end of the day. That's kind of, I guess, how I would say those things connect. I don't know if that answered your question, Phil. Think about those two components. Certainly, where a certain sector or where a certain share falls in that value to growth spectrum. And then, yeah, what's that corresponding sensitive, defensive, cyclical? Because I think a lot of people get very confused at this stuff and they buy seemingly cheap shares at the top of the economic cycle. And then they're very surprised when those share prices come down significantly and the company does worse when the economy starts going down. So yeah, I think people get a little bit confused with that. All right. So let's look at some different ways that people can invest within this fundamental investing approach, and some kind of tricks I think that you can use, because I think we get very confused with a lot of this. We think that to be a fundamental investor, to focus on the fundamentals, understanding that business and valuing that share, means that we need to do what an analyst does, right? And that's the first row up here. That analysts use discounted cash flow models to assess the value of the company by assessing future cash flows, discounting back to the present day. So that's what analysts do to value a company. And it's hard. And it's hard for a lot of reasons. It's hard, number one, because you're obviously estimating what happens in the future. You're predicting what happens in the future. It's very time consuming to put together a discounted cash flow model. And most individual investors just don't do this. But that doesn't mean that there isn't value to understanding how it works. And it doesn't mean there isn't value to looking at those models, or at least understanding the inputs into those models to assess how a company may perform. And really kind of the implication is that if you check the assumptions implied in the DCF model and figure out if you think they're going to hold up, right? So what those include are obviously growth rates and earnings. Obviously, there's some sort of implied margin in there. How much of revenue are they going to keep as earnings? So all these different assumptions that go in there, you can sit there and think, does this make sense? And the example that I always use, and what I used up in Brisbane, was Tesla. You know, Tesla coming into the year, everyone agrees that Tesla is going to grow quickly, right? But many people just say that the reason to buy the share is because it's going to grow quickly. Well, it's like, well, wait a minute. We need to look at the price, right? We need to look at what we're paying for that growth. Coming in this year, Tesla was trading at something like 350 times earnings. Now, I don't know if that was a good price or a bad price or what it's going to mean in the future. But what I do know is obviously there's a lot of growth assumed in there. So that's a opportunity for you as an investor to sit there and think about, okay, what's actually going to justify that? We know it's not going to trade for 350 times earnings 10 years from now. So if we look out 10 years, and maybe it's trading at double the market multiple then, how fast is it going to have to grow for it to come from 350 times earnings to like 70 times earnings? So what's implied in that price that people are paying? So understanding how a discounted cash flow model works, understanding the drivers and assumptions that are built in there can be very helpful. The other way, and sort of we were talking a little bit about this, I just was, is when we look at relative valuation measures. So if we're looking at a price to earnings ratio or price to sales or price to book or price to cash flow or anything like that, realize that that number means nothing on its own, that there's a lot baked into that number. And what's baked into that number is, once again, assumptions about that company. How fast is it going to grow? How is it going to maintain margins over time? Especially if we look at some of these fast-growing companies that are in emerging fields, a lot of times it's very difficult to maintain that margin over time, right? So if we use Tesla again as an example, that everybody and their mother now is making electric vehicles. And so you're having all the traditional car companies invest in all these electric vehicles. And so the question is Tesla going to be able to keep selling cars at a premium with all this competition, or they have to cut prices at some point? I don't know the answer to that. There's a lot of different opinions, but just thinking about, okay, once again, like in this emerging industry, what are some of the impacts that could impact, of course, that price to earnings ratio over time? Is it only really high because they have a really high margin, because they have a really high growth rate, or either of those going to slow over time? What's going to happen to that relative valuation measure that you're looking at, that valuation measure you're looking at? So once again, understand the context of the company and the industry they operate in. And finally, something I talk about a lot, mostly because I think it's good, is thinking about you and putting this in the context of you. So over the long term, where are those returns going to come from for you? Are they going to come from dividends? And remember, dividends and dividend growth can be very, very powerful if you're a long-term investor. But is it your return going to come from dividends and growth in that dividend? Is it going to come from changes in valuation measures? Remember, if we're buying something that has a very high valuation measure, like that Tesla example, it will come down. So that's a negative on the return. Then, of course, earnings growth. Where's that earnings growth going to come from? So we put all those different factors together and just come up with scenarios of where you're going to get that return that you need. If you need 8% a year, how do you get to 8%? Well, maybe you get there with 3% dividends. And maybe you get there because you think the company will grow 5% a year. Well, all of a sudden, there you go. You're at 8%. Think about that valuation level, if it's going to change. So just think about those different drivers, right? And people imply these when they talk about shares, but they never actually make them that concrete. People say that, oh, I think the valuation will go up on this company. It's hit temporary issues and it will go up. Like, okay, well, that's your thesis. Your returns are going to come from increasing valuation levels, or they're going to come from dividends or earnings growth, et cetera. So something to think about there. So the point of this is really just saying that it's very difficult, no matter what valuation measure you're using, it's very difficult for it to draw any sort of conclusion without you understanding the company. And that's keeping things within that circle of competence. It's understanding that industry, understanding the different competitive balances in that industry and how that's going to impact you as an investor. All right. Well, that's all I was going to go through. So I will stop this little cough fest for now, which I think will make everyone happy. But anyway, thank you guys very much for joining. If anyone is at the ASX Investor Day in Sydney on Saturday or in Melbourne in early December, stop by the Morningstar booth and say hi. You can meet Emily. She'll be there. She's really excited to be working on Saturday. I can just tell. But anyway, thank you guys. And sorry for all the coughing. I apologize. Maybe I'll be dead by Saturday. But anyway, thank you guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.